We're going to discuss balance of payment today. We're continuing with where we have left with the international trade theories. In international economics, whatever a company has to offer for international trade, it comes in the form of exports and imports. The total productivity of a country and the total consumption in the country must differ from each other. There will be a trade surplus once a company has developed the means of resources and continued to produce more than what it supposedly can consume. If a country is trade surplus, it is going to earn foreign exchange, which can be utilized for payment for imports. We're going to study quite a few aspects about the trade and how the trading of visible items and trading of invisible items are going to be shown in the books of that country. The term the balance of international payments usually refers to a systematic and summary of record of a country's economic and financial transactions with the rest of the world, including all the foreign countries, over a particular period of time, and normally one financial year. It's a systematized procedure for measuring, summarizing and stating the effects of all financial and economic transactions. So balance of payment on a normal layman's basic point of view is about what is the total surplus amount in its foreign exchange reserves without considering every other item related to international trade. It has to be systematically monitored and recorded. If there is a fluctuation in the foreign exchange ratio of one currency with another, it is going to fluctuate over a period of time. In early 1990s in India, when Mr. Chandrasekhar was the Prime Minister, India had an abysmal record of balance of payment. India almost went bankrupt. Because of a dwindling BOP, the Chandrasekhar government had to resort to deposit golds which were owned by the central government of India with the International Monetary Fund. Now, as the economic scenario has improved much in Indian subcontinent, the Indian central government has been purchasing all these years the golds which were earlier reserved with International Monetary Fund. These monetary transactions in terms of trade, imports and exports includes exchange of goods and services, and at the same time it can also include various transactions which are of unilateral in nature. That's extension of a loaning facility by one country's government to another, or short-term and long-term portfolio investments by foreign institutional investors in our country. For all these transactions except gifts and grants, payment is involved in foreign balance of payment currency, which means it involves payment of foreign exchanges, dollars, liras, pounds, euros, and etc. A transaction is normally recorded as being either a credit or a debit item, depending upon the direction of the payment. If the transaction results in a cash outflow, it's going to be a debit in the books of accounts, and if the transaction results in inflow of funds, it's recorded as a credit in the books of accounts. The International Monetary Fund defines and describes the concept of BOP as transactions in the goods and services and income between economy and rest of the world. So it is naturally transactions in goods and services. It also includes changes of ownership and other changes in that country's monetary gold and special drawing rights, and claims on and liabilities to the rest of the world. Similarly, also includes unrequited transfers and counterpart accumulated entries that are needed to balance in the accounting sense any entries for the foregoing transactions, and changes which are not going to be offsetted by mutual benefits. So basically, balance of payment describes the situation of transaction of goods and services and change in ownership of important items like gold. The format of a country's balance of payment includes 4 mutual heads, mutual accounts, which is prepared by concerned government to show the structure of BOP. The first of such thing is current account, the second is a capital account, third is unilateral payment, and fourth is official reserves account. First of all, we are going to discuss the current account, which includes all the transactions which gives rise to national income. Either it gives rise to national income or it utilizes the national income, which means if it is an inflow, it will increase the national income. If it is an outflow, it is going to decrease the national income. The current account generally consists of 2 general major items: the merchandise exports and imports. First of all, that is the tradable goods and services. The second is invisible items of exports and imports. Invisible item relates to services alone. Merchandising exports, because it means sale of goods abroad, it is going to give rise to inflow of funds. So that's a credit entry. On the other hand, the merchandise import, because that's of the nature of purchase from international market, it's going to give rise to foreign money claims on our part. So that's a debit in the account. Merchandise imports and exports from the post-import international transactions of most of the countries, which means it consists of 60 to 70% of total trade and total BOP of a particular country in a particular financial year. The next part is invisible exports, which is of course part of the current account. Invisible exports, which means sale of services, are credit entries, and invisible imports, purchase of services, are debit entries. Many of the invisible exports includes transport and insurance, banking, hospitality industry. Similarly, purchase of foreign services, the import of services, import of invisible items, include getting service from foreign countries, which obviously means that you are going to pay a lot of money, lot of foreign exchanges to outside countries. In that case, it's a debit entry in the current account. For example, for India, software has become one of the largest service exports, contributing nearly $75 billion to Indian economy. Similarly, there are a lot of services including the banking services which you get from outside, which becomes one of the invisible imports for Indian economy. Now we can summarize the components of balance of payment on current account. First of all, we are taking the visible items, long-term physical goods, balance of trade. Balance of trade is equal to export of goods minus import of goods. Balance of invisible, that of the service, is export of services minus import of services. Both are invisible items. Adding both of them, we get balance of payment on current account. A plus B, balance of trade plus balance of invisibles becomes balance of payment on current account. The next account that we are going to discuss is capital account. The capital account consists of short-term and long-term capital transactions. Capital outflow represents debit and capital inflow represents credit. For instance, for example, if an American firm invests $100 million in India, this transaction will be represented as a debit in US balance of payment and a credit in the Indian balance of payment. Payment of interest on loans and dividends are recorded in current account. Since they are really payment for the services of capital, as has already been mentioned, interest paid on loans given by foreigners are debit for the home country, while because the same is to be received by the foreign countries, they will be credit in the foreign countries. The components of BOP on capital account can be summarized as follows: foreign investment, portfolio investment. Foreign investment is basically can be summed up by FDI by foreigners in India minus FDIs by Indians abroad. So whatever we are getting as inflow minus whatever we are getting as outflow. When foreigners invest in India, we are going to call it inflow, and when Indians are investing outside, that's an outflow. So FDI by foreigners in India minus FDI by Indians abroad, giving rise to net foreign investment. The next point is portfolio investment. Similar to foreign investment, the portfolio investment by foreigners in India minus the portfolio investment by Indians abroad, which gives us net portfolio investment. Loans, the next point. It comes in the form of external assistance, commercial borrowings, and deposit by NRIs. So three things constitute loans. External assistance can be regarded as given that by the foreigners in India minus Indians abroad. These are assistances provided by foreign governments to Indian government and Indian government to foreign government. Commercial borrowings is commercial borrowings by foreigners in India and by Indians abroad. When you subtract the former from the latter, you will get the net commercial borrowing. Similarly, we can get deposits by NRIs. Deposits by NRIs, the net deposit by NRIs in India, we can get it by subtracting withdrawals by NRIs from fresh deposits by NRIs. So total deposits minus the withdrawals gives us net deposits. By adding the total of foreign investment, portfolio investment and loans, we get balance of payment on capital account. FDI will occur because the first point of this thing is FDI. FDI will occur when a foreigner sets up or acquires control of production units in India. The foreigner transfers funds from his country to India. Such transfers constitutes credit entries in the capital account because it's going to be regarded as inflow into Indian economy. On the other hand, portfolio investment constitutes transfer of funds between nations to acquire financial assets. So if a foreign institutional investor purchases stocks of an Indian company in the stock market, suppose a National Stock Exchange or Bombay Stock Exchange, foreign exchange will flow. This is regarded as an inflow, that will be credit. So portfolio investment into India is regarded as a credit entry in capital of BOP. Similarly, when an Indian company is going to invest in a foreign country by way of investing in through the stock exchange, that is regarded as an indirect entry, is going to be a debit entry in the balance of payment capital account of Indian economy. The balance of payment is just the sum of these two accounts, the capital account and the current account, and calculated as follows. BOP is current account balance plus capital account balance. The sums of both these accounts should always be equal to 0, which means if one is positive, the other one should be exactly same amount negative. So this will happen that the BOP would be 0 if the current account and capital balances are exactly equal amount and moves in the opposite direction. If the two accounts are not equal, this gives rise to the requirement that a resort is made to the reserves of foreign exchange available within the country, which means if the net amount is negative, then you are using the foreign exchange what is accumulated with the country. If the net account of BOP is positive, then you are subtracting and adding the balance surplus of the BOP account to the foreign exchange control account already available with the central government, which is of course controlled by the RBI for the central government of India. Unilateral transfers is another term for gifts and includes private remittances, government grants, preparations and disaster relief. Unilateral payments received from abroad as credits and those made abroad as debits. Sometimes if a natural calamity strikes a country, foreign governments do help by way of unilateral transfers by giving a non-refundable loan or a refundable loan, which is called as a soft loan, which is normally provided for a 20, 30, 40-year basis at a very small amount of interest. If the Indian government provides a unilateral transfer to another country during the course of a particular year, that is regarded as a debit in its BOP account. Official reserves account. Official reserves account represent the holdings by the government of India's official agency, that's normally the RBI, of the means of payment that is accepted for settlement of international claims, which means this is the foreign exchange reserve account that is being held by RBI for India, from which payments are made on behalf of central government of India and payments are received on behalf of central government of India. Now we have come to analyzing the balance of payment data for the Indian government from the year from 1991 till 1998-99 in the first phase, and then till 2004 and 5 in the second phase. In the year 90 and 91, that is the before liberalization took place in India, the export was $18,477 million, US million dollars, and imports were almost 1.5 times, 50% more. The trade balance was negative, and the net invisible items, the trade balance of the services, were also negative. Total current account balance was negative to the tune of $9,680 million. The capital account balance was although positive $8,402 million. So thereby the BOP was negative. But there is a dramatic shift when the liberalization took place in a period of 7 years. The exports has just doubled and imports has almost doubled. The trade balance, negative trade balance, has increased, and invisible trade balance also increased. Thereby there is a surplus trade balance in the year 1997-98. The situation remained critical till 2000 and 2001. But the year 2001 and 2, there was a dramatic shift in the net invisible items in the current account. Even though the balance of trade was huge negative amount of 11,574, which goes on to show that the exports are much less than that of the imports of the country, the invisible account showed a large amount of increase. The net invisibles became 14,974 crores, $74 million, which means almost 15,000 US dollar millions. So thereby both capital account and current account balance was plus. The situation increased as the amount of FDI that is coming into India increased the capital account balance year on year. In the year 2003 and 4, the exports, which are standing at 18,000 in 1991, almost increased to 65,000 US million dollars, and this is an increase of almost 3.5 times in the exports in these years. But there is a moderate increase of 2.9 times in the amount of imports. From the invisible items has large amount of surplus, which means from a negative $242 million in 1991, it became a huge surplus of 26,000 US million dollars in the year 2003 and 4. So this goes on to show that the balance of payment of India has increased, goes on to rectify, automatically correct these things over a long period of time. The table reveals that India's exports in the year 97-98 has increased as much as 81% from 97-98 to 2003 and 4, which goes on to show that there is a strong emphasis on the amount of exports in the Indian economic policy. If as an economy we are able to increase our exports to a larger extent, what it means that we will be less dependent upon goods which we are earlier purchasing from outside. So the burden of payment of foreign exchange to outsiders will reduce by the day. That is a good sign for Indian economy. India's major trading partners in these years are USA, UK, Belgium, Germany, Japan, Switzerland, Hong Kong, UAE, China, Singapore and Malaysia. So fairly good relation with the USA bloc and the EU bloc, but still we are not having enough trading with our nearest neighbors, Pakistan, Bangladesh and Sri Lanka. The Economic Survey of India 2004 and 5 reveals that the exports registered an increase of almost 26% in dollar terms, substantially very much higher than the annual target of 16%, and previous year it was almost 12%. So exports are growing more than that of the imports. That is a good sign for balance of payment situation. In the foreign trade policy 2004 to 2009, government fixed an ambitious target of 150 billion US dollars for exports by the year 2008 and 9, implying that the US overall Indian export will going to grow at around 20% for the next few years. So which means it is going to automatically correct amount of India's trade in the international trade in India. But still that's a very debative issue whether India's international trade percentage is actually going to be enough, which is currently standing at 2% of international trade, whereas a country like USA controls 24% of international trade and Japan contributes 12% to international trade. So as a country of our size, India is not doing too well in terms of share in international market. India's import, though it has registered less percentage than the exports. During the same period in which the exports grew 81% from 97-98 to 2003 and 4, India's imports grew only 57%, which means the exports grew much more faster than the imports. But there was a disturbing trend, that even though all other imports were falling, the import for energy resources like oil, petrol, diesel and all is giving a very growing larger percentage of increasing sign. So we have to discover and utilize as long as possible and as quickly as possible that we are going to discover oil resources within the same country, or we have to find cheaper sources of oil from international market. When we attempted to calculate and compute Karl-Pearson coefficient correlation between export and import during a period of 14 years from 1992 to 2004 and 5, the correlation showed plus 0.962, which means there is a strong positive correlation between imports and exports. So which means if imports are increasing, that does signify that the India's exports are also increasing in similar manner. You can call it in another manner that if India's exports are increasing, then it is slightly increasing more than the imports. But the most cordial fact is that, most heartwarming fact is that India's exports are fueling the inflow of foreign exchange reserves, which are in turn utilized for purchasing from outside. The balance of payment in disequilibrium. I have already told you that the balance of payment of a country is said to be in disequilibrium when the demand for foreign exchange is equivalent to the supply of it. The balance of payment is regarded as being in disequilibrium when it shows either a negative or a positive balance. Positive is surplus and otherwise it's a deficit. There will be a deficit of balance of payment when the demand for foreign exchange exceeds supply, and there will be a surplus when supply of foreign exchange is greater than demand of foreign exchange. So balance of payment of most countries are in disequilibrium nowadays. There are a number of factors that may cause actual BOP disequilibrium. These various causes may be broadly defined as economic factors, political factors and sociological factors. First of all, we are going to discuss the economic factors. There are a number of economic factors which can cause disequilibrium in balance of payment. Development disequilibrium, cyclical disequilibrium, secular disequilibrium and structural disequilibrium. Development disequilibrium we are taking up first. India is a developing country. I will give you an example of how deficient we are in terms of infrastructure. In US alone, there are more than 750 airports of very good quality, international quality. But in India, we have only 200 airports, out of which only 40 are good quality, and all the other are of very small capacity. India has roughly 40,000 kilometers of three-way national highway, three-lane double carriageway national highway. But China has more than 1,30,000 kilometers of double carriageway three-lane expressways. India's total strength of railway kilometers is stagnant at 70,000, and only 200 kilometers is added up every year. But in China, the railway started later, but right now in the year 2011 and 12, there are more than 85,000 kilometers of railway, out of which almost 4,000 kilometers are very high class bullet train capability. And every year they are adding 650 kilometers or more railways to its strength. Where do India stand? To become developed countries, we need infrastructure development. To increase purchasing power, to increase the per capita income, we need infrastructure to be in place. So large scale developmental expenditure will increase all these things. But where should we get the money? Because we need money from outside, there is huge pressure on our foreign exchange demand. So that's why there is a deficit in our balance of payment, because we are taking more loans, we are importing more goods, more equipments, more machines, more technology from outside. So development disequilibrium rising because of the large scale need to build infrastructure, build large scale developmental activities. The next is cyclical disequilibrium. As Lawrence Toll puts it, depression always brings about a drastic shrinkage in world trade, while prosperity stimulates it. A country enjoys boom and grows at a large speed, then there is suddenly depression and recession. Imports are becoming more than exports. We are not creating enough surpluses. Our consumption is very high. Because of higher population, the demand for goods and services is quite high. So whatever we produce, we consume 90%. So only 5 to 8% is saved for future investment. So in a productive, consumptive and productive country like India, the surplus GDP is very low, and we are often contradicted by the cyclical fluctuation in business activity. So because of those cyclical direction, there is bound to be balance of payment disequilibrium because of non-adherence to the rules of the law. Third disequilibrium is that of secular disequilibrium. Sometimes the balance of payment of disequilibrium persists for long periods because of secular trends in the economy. For instance, in a developed economy, the disposable income is very high, generally very high. So there is aggregate demand. The aggregate demand is lying at a higher position. At the same time, because of higher nature of the payment of wage, there is aggregate demand. At the same time, the production of goods and services are becoming more and more. This naturally results in higher prices. These two factors, high aggregate demand and very high domestic prices, result in the imports being given more importance than exports. That's why there is secular disequilibrium. The last of these economic points is structural disequilibrium. Structural change in the economy, that we have become developing from underdeveloped. Now we are in the stage of being made a developed economy from developing. Such structural changes, like 10 years back we hardly had internet connections, but now we have more than 500 million internet connections in India and more than 750 million mobile subscribers. 2G has come, 3G has come, and then there is a talk of introducing 4G in India. Such structural changes require large amount of alternative investment. We need to find development better substitutes, exhaust our resources. The requirement of consumption of coal, energy, electricity is huge, humongous proportion. The transportation cost is rising every day because of increase in prices for oil. That's because we don't produce enough of our demand. We only produce 35% of what we consume. So we need larger amount of BOP, and that is not to be. So that is the basic structural disequilibrium hampering our economic growth. Then there are political factors. Certain political factors could also produce balance of payment disequilibrium. If there is political instability, government changing every 2 years, if the central government falls in India and a consequent general election happens, the general election will cost India a huge 1,000 crores to the government exchequer apart from private investments. That is not easy. Political instability will bring discontinuance of rules and regulations. The policy decisions taken by one government may not be continued by another government. So these factors sometimes cause critical changes in the structural development planning, long-term planning. Similarly, if there is some kind of civil war, terrorism activities, warlike situations, they can bring similar very difficult times for the government, and the balance of payment situation will be very negative on these sources. The last of these factors is social factors. There are certain social factors like taste and preference, fashions. They cause us to import fashionable goods. We like to wear Red and Taylor, Dolce and Gabbana, Nike, but how many of them are produced in India? So because of taste and preference, changes in the habits, the customs, the cultural differences, they create imbalances in favor of imports being given precedence over exports. That happens in automobile sector all the time. We import Ferraris, we import Audis, Mercedes, Rolls-Royce, etc. We have to pay huge amount of foreign exchange for that. But somehow, because of all these things, even if the balance of payment disequilibrium is arising every day, we can have an adjustment mechanism to slightly correct the balance of payment. A country is not, it should not be always bothered about the BOP disequilibrium. We should strive to remove or reduce the BOP by increasing our exports. How? For example, our agricultural GDP, out of our agricultural GDP, we consume 80%. 2 to 4% is lost because of lack of godowns, because goods are stocked in open grounds, thereby reducing it to be exposed to floods, rains and all the things. We have to keep some stock for some reason to meet external calamities. So we are left with 5 to 8% of agricultural GDP which can be exported. That's not enough. We must increase the agricultural GDP because 40% of India's population depends upon that. So it creates an environment in which we are only exporting 8% of agricultural GDP and importing lots more products from outside. Similarly, in manufacturing sector, China is growing 30% each year. It has more ports, more airports, more railway stations, more kilometers of railways, more planes, larger population engaged in manufacturing, large scale mass production of FMCG goods, electronic goods. Where do we stand? We need to produce on large scale so that we can flood outside market with our exports which are cheaper. But there are naturally a number of adjustment mechanisms which is available to correct the balance of payment disequilibrium in general. There are two general groups, automatic and deliberate. Automatic, it happens automatically, and the deliberate measures are those measures which should be taken expecting that it is going to correct the balance of payment situation more or less to a certain extent. The first of these points is automatic correction. This automatic correction mechanism worked well under the gold standard which are prevalent all over the world before 1973. But the balance of payment disequilibrium, the imbalances can be corrected to some extent under the paper currency standard also because the gold standard doesn't exist in most of the countries. The theory of automatic correction is that if market forces of demand and supply are allowed to have a fair play, which means they are not interfered with, automatically the restoration of BOP will happen. For example, assume that there is a deficit in the balance of payment. When there is a deficit, the demand for foreign exchange exceeds its supply, and this results in an increase in the exchange rate and fall in the external value of domestic currency. This makes exports cheaper and imports dearer. Consequently, the increase in exports will happen and there will be foreign imports. They will restore the disequilibrium. But to how much degree the disequilibrium will be restored, will be corrected, is a thing of speculation. So sometimes it works to a certain extent, sometimes it doesn't work at all. The deliberate measures, on the other hand, are methods which can be taken by monetary authorities, trade authorities and the government. Three methods are normally there: monetary measures, trade measures and miscellaneous measures. The first of the measure is monetary measures. One of the methods is monetary contraction, the second is devaluation, and the third is exchange control. Monetary contraction. Supply of money has to be diminished. The level of aggregate domestic demand may be influenced by contraction or expansion of money supply. For example, in the times of inflation, because inflation happens because of more demand and less supply, because the purchasing power with the economy, with individuals, with citizens are normally higher, they continue to demand more of the commodities over a large period. If a large percentage of inflation keeps on happening, then we can contract the money supply, thereby decreasing the monetary purchasing power available with these people. When the purchasing power is less, they will demand less. As a result, demand would be less than that of supply. It will correct to a certain extent. So in that case, inflation will ease up. The demand for imports will also come down. Thereby there will be a certain amount of correction in the money supply which is required. Contraction of money supply is likely to reduce the purchasing power and thereby the aggregate demand. It is also likely to reduce domestic prices because the demands are coming down, supply remaining constant, there will be ease in the prices. The domestic prices will reduce the demand for imports because the prices are high. The fall in domestic prices thus likely to increase exports because the current prices are lower and international market gives you more prices. You would like to sell in international market and not in domestic market. So fall in import and rise in export will bring more inflow of funds, thereby substantially correcting the BOP disequilibrium to make it positive. Devaluation of the currency. Devaluation means the reduction of the official rate at which the currency is exchanged for another currency. A country with fundamental disequilibrium in balance of payment may devalue the currency to stimulate its exports and discourage imports. When the price comes down, the value of the currency in terms of another currency comes down, it will make the imports much dearer and exports cheaper, which means export will go up and imports will come down. Exchange control. Exchange control is a popular method to employ to influence the BOP. Under exchange control, the central bank of the country assumes complete control over the foreign exchange reserves and earnings of the country. The recipients of the foreign exchange, like exporters, are required to surrender all the foreign exchange they receive to the government and the central bank in exchange of domestic currency. By virtue of its control over the use of foreign exchange, government can control imports. This is exactly what happens in most of the countries. The total amount of foreign exchange available in India is controlled by the Reserve Bank of India. So no other player is allowed to exercise and effect any kind of exchange control without the knowledge of RBI and the permission of the government, central government, in prior notice. Trade measures, the second measure. There are two measures in under trade measure: import control and export promotion. Export promotion is encouraged by reducing export duties, providing subsidy to exporters, providing tax subsidy. People and companies and firms who are allowed and encouraged to produce for exports only, they are given monetary, fiscal and physical incentive and facilities. For example, the central government of India has been able to establish a number of special economic zones, software and technology parks, STPs, electronic hardware park. There are a number of these incentives that from the year 2001 to 2010 and 11, there used to be a rule under section 10A of Income Tax Act that any firm engaged in 100% export oriented undertaking is allowed to deduct 100% tax deduction for the next 10 years under these time limits if it continue to export all the products and not sell any of its products in the domestic market. So that is a huge amount of benefit which was doled out by the central government to the firms which are working inside special economic zones and export oriented undertakings. They used to continue to get large amount of incentive in the form of tax subsidies. The next point is import control, which means imports are not regulated, but a certain kind of control is exercised by the government, so that government says that you cannot export these goods because there are substitutes which are available within the country. So imports may be controlled by improving and enhancing import duties, increase the import duties, restricting imports through import quota, which means there is a known as a quantitative restriction. You cannot import more than that. You are given a license which stipulates a particular amount of import which you can make, and even prohibiting import of certain essential items. inessential items, items which are not required in general, which involves large amount of foreign exchange, is normally not allowed to be imported by the central government. Miscellaneous measures. Apart from measures which are mentioned above, there are a number of other measures that can help make it the balance of payment of disequilibrium a more favorable position, like opening foreign tourists. For example, India is one of the largest, in fact, the sixth largest tourist destination in the world. It receives around $30 billion from tourists every year. Issuance of tourist visa, creation of hotels and resorts, transportation facilities, railway facilities. So this money comes into India because of development of various tourist destinations, temples, temple towns, eco destinations, temples, large scale forestry, beaches in Goa and other places. So these are a form of bringing foreign exchange into India. So we can, these are miscellaneous measures because these are small measures, but over a period of time from $1 million it has gone to several billions. So we can sum up the whole thing by way of this diagram. Correction of BOP disequilibrium by automatic correction and deliberate measures, monetary measures, miscellaneous measures, and the third one is trade services, export promotion and import control. So you know, I have already discussed all these things. You should know all these points in detail. We have come to the conclusion and end of this session. So balance of payment is very necessary and may be used as an indicator of economic and political stability of a country. It also goes on to show the economic growth and economic empowerment of a country. It may also mean that a country doesn't export much of its currency because it earns large amount of currency from exports. It goes on to show the relative value of a country. It is one of the measures which includes trade balance, foreign investments, investment by foreigners in India and in the host country. So BOP, I can sum it up like it's a measurement of the efficiency of an economy over a large period of time, which tends to make us believe that the economy has gathered momentum from the fact that exports are growing at a large pace than the imports of the country, which is a good sign for India for the years to come. I hope you have understood the subject. Next time we'll be starting up a new session, new topic. Till then, bye bye. Thank you very much.